This is Meet Sean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
Welcome to the deep dive. So, you came to us today looking for a quick and thorough understanding of one of the most critical challenges in personal finance,
Right.
making sure your savings last all the way through retirement.
A huge challenge.
The goal is always a steady income, guaranteed, no matter if you live to 85 or 105. But planning for that kind of longevity, it can feel, well, paralyzing.
It creates a massive psychological and financial hurdle. It's what we call longevity risk.
Longevity risk.
Yeah, it's the risk of outliving your money.
Yeah.
I mean, traditional retirement portfolios, they were all about accumulation. Today, we have to focus on distribution and making sure that money just doesn't run out.
Okay, let's unpack this. Our mission is to understand one specific tool that the source material positions as the answer to this exact problem: annuities. We really need to cut through the jargon, the sales pitches, and just understand how these financial tools work, why they can offer a guarantee, and maybe most importantly, what trade-offs you make when you accept that guarantee.
Precisely. And we should start with the foundation. At its very heart, an annuity is a legal contract. It's an agreement between you, the individual, and an insurance company.
Okay, a contract. And what are the basic terms of that contract? What's the exchange?
Simple, really. You provide the insurance company with capital. That could be a single big lump sum, or it could be a series of contributions over time.
Right.
And in return, they agree to provide you with regular, predictable payments. These payments can be structured to last for a set number of years, or, and this is the key differentiator, for the rest of your life.
So it's basically the ultimate conversion tool. You're turning this static pile of savings into a stream of guaranteed income.
Exactly. It's a risk transfer mechanism. You're essentially paying the insurance company to take on your longevity risk.
You're shifting the burden of guessing how long you'll live and managing that money entirely over to them.
That's it.
And that brings us right to the core value proposition here: solving the uncertainty problem. Because if you've spent 40 years saving, the absolute last thing you want is market volatility eating into your core living expenses.
That's the real fear, isn't it? Annuities are designed to act as a kind of financial security blanket. You might have Social Security or a pension providing a base layer of income.
The floor.
A floor, yes. And annuities are meant to supplement those sources, ensuring that core expenses like housing, healthcare, food are always covered, regardless of whether the stock market is booming or, crashing.
Here's where it gets really interesting for me, because this commitment, this guarantee from the insurance company, that's the powerful engine here. How can they promise that income for life? What's the mechanism that makes their guarantee financially sound?
It all comes down to the law of large numbers. The insurer pools the money from thousands and thousands of clients.
Okay.
Now, some of those individuals will unfortunately pass away sooner. Others will live much, much longer, maybe into their late 90s or even past 100. The insurer calculates what are called mortality credits across that entire pool. That lets them confidently promise payments for life without running out of cash.
So it's fundamentally an insurance play, not just an investment play? That makes a lot of sense.
That distinction is vital. It positions annuities as asset protectors. They bring stability to your overall retirement picture, which then allows you to, maybe allocate the rest of your assets toward growth with a little more confidence.
Now, when people start looking into these, they quickly realize that annuity is a huge umbrella term. Our sources break it down into 4 distinct blueprints, really, each designed for a different goal.
That's the customization component. And choosing the right type, it really depends on your risk tolerance, your age, and crucially, when you need that income to actually start.
Let's walk through them, starting with the most secure, most conservative choice: the fixed annuity. Who is this for, practically speaking?
Fixed annuities are the simplest, the safest option. They're perfect for conservative investors whose main goal is preservation, not growth.
Just keeping what you have.
Exactly. The key feature is a guaranteed interest rate set by the insurance company. That rate is locked in for a period, which gives you absolute predictability.
So if you're already retired and you have zero risk tolerance for the money that covers your property taxes, a fixed annuity is basically a high-yield CD backed by an insurance promise.
That's a great way to put it. But if an investor wants a little taste of market growth without the risk of their principal going down, they often look toward indexed annuities.
I see index annuities mentioned everywhere. They sound like they offer the best of both worlds, which, usually makes me a little nervous.
Hey, it should.
So how do they link returns to a market index, like the S&P 500, but still protect your initial investment?
It's a clever structure, but you have to read the contract carefully. The key feature is the floor, usually 0%, which means your principal is protected if the market crashes.
Okay, so you can't lose your initial money.
Correct. However, your upside potential is capped. It's often through something called a cap rate or a participation rate.
So you get some of the upside, but not all of it, in exchange for that absolute guarantee that you won't lose money when the market tanks. It's a classic risk-reward trade-off.
Absolutely. It's for the cautious growth investor. It just removes that downside exposure, which is very appealing to people who got burned by market crashes in the past.
We switch gears a bit from how the money grows to when you get paid. This is the big difference between immediate and deferred annuities. Let's start with immediate.
Immediate annuities, or SPIAs, single premium immediate annuities. They're very straightforward. They're for people who are retired right now and need income to start flowing within a year.
So you hand over the lump sum.
And the paychecks start coming almost immediately.
That is the instant gratification version. You just convert that capital into cash flow. Done.
Exactly. Conversely, you have deferred annuities. These are designed for someone still working, maybe in their 40s or 50s. Their main feature is that long accumulation phase.
The growth phase.
Right. The money grows on a tax-deferred basis, potentially for decades, before payments ever begin. They're essentially a tool for saving for an income stream far off in the future.
That's a really powerful distinction. It means annuities aren't just for people at retirement age. They can be a long-term savings vehicle, especially for someone who's already maxed out their 401k and IRA.
And the customization across those four types, fixed, indexed, immediate, deferred, it just ensures that the product can be tailored to fit almost any investor's timeline and risk preference.
Let's pivot now to the strategic advantages that make annuities stand out. We've touched on it, but that first one, the most important one, is the guaranteed income for life.
And that feature fundamentally changes your retirement strategy. It means you can cover all your essential non-negotiable expenses, your housing, insurance, utilities, with these guaranteed income streams.
Which frees up the rest of your portfolio.
Exactly. It frees it up to pursue higher growth opportunities. This allows for a massive reduction in the mental stress that comes with watching the market every single day.
And the second big advantage is the financial mechanic, tax-deferred growth. For someone in that deferred accumulation phase, how does that give them a strategic edge over, say, a normal brokerage account?
The power comes from uninterrupted compounding. Since your earnings aren't taxed until you withdraw them, 100% of your gains are reinvested year after year.
So it just snowballs faster.
It dramatically accelerates growth compared to a regular account where you're paying capital gains tax along the way. And then when the income starts flowing, only the earnings portion is taxed, not the return of your original principal.
So strategically, it's not just a savings vehicle, it's also an efficient tax wrapper for growth.
Precisely. And what's more, the payout phase itself offers vital customization. You can choose income for a set term, say 15 years, to cover a mortgage or income for as long as you live.
That said, annuities can't be a silver bullet. If an insurance company is offering me all these guarantees and tax advantages, I have to ask, where are the catches? What are the strategic pitfalls an investor really needs to know about?
This is maybe the most important part of this deep dive, because that guaranteed income comes at a cost. The biggest pitfalls, I'd say, fall into three categories: fees, illiquidity, and insurer solvency.
Okay, let's tackle fees first. What kind of costs should you be looking for in that contract?
Well, you have to be aware of high commission structures, particularly with indexed and variable annuities. They often reward the agent quite handsomely.
I've heard that.
And second, you have administrative expenses. And riders, those are extra features you can add like death benefits or inflation adjustments, and they can all significantly erode your returns over time.
Okay, what about liquidity? If I pour a massive lump sum into an immediate annuity, can I pull that money out if I have a sudden emergency?
Generally, no. And this is a major strategic constraint. Annuities are designed for long-term income, not as a short-term savings account.
So if you try to withdraw funds early,
You face what are known as surrender charges. These are substantial fees, often structured to phase out over 7, maybe 10 years. They punish you for breaking the contract early. You are absolutely trading access to your capital for that guaranteed income stream.
that's a massive trade-off. It really underscores that you should only put money into an annuity that you are absolutely certain you won't need for other things.
Exactly. And the final risk is unique to this product: solvency risk. Just remember, the guarantee is only as good as the company backing it.
Right. If the insurance company goes bankrupt, your promised income stream is in trouble.
It's jeopardized, yes.
So the expert advice here is pretty clear. Look at the insurance company's credit rating, their financial stability, before you sign anything.
Absolutely. You should rely on third-party rating agencies like Moody's or S&P to confirm that the insurer has a superior rating, that they can meet those obligations for the long haul.
This strategic balancing act, weighing the powerful benefit of the guaranteed income against the significant constraints of surrender charges and credit risk, that's what defines a well-informed approach here.
If we connect this to the bigger picture, it becomes clear that annuities should be a strategic component designed to work alongside everything else.
Your 401k, brokerage accounts, real estate.
All of it. They provide the floor, which then allows the rest of your assets to climb the walls, so to speak.
That framing, the annuity providing the financial floor, that is crucial. So what does this all mean? We've looked at annuities as these powerful financial tools designed to combat longevity risk and market volatility.
Right. They do that by offering guaranteed, tax-advantaged income streams.
We've broken down the 4 primary types, and critically, we've analyzed the necessary trade-offs you have to make on fees and liquidity to secure that lifetime guarantee.
We cover the whole blueprint, really, from the basic contract definition and the principle of risk transfer to the customization of fixed, indexed, immediate, and deferred products, and the strategic importance of understanding those surrender charges and the insurer's strength.
And it's important to remember that this tool exists within a larger planning universe. I mean, you can see that in the breadth of services offered by the firms mentioned in the source material, like SeanWillInsure.net and Carter Fiscal Group, LLC out of Naples, Florida.
Right.
Comprehensive planning means looking beyond just the annuity itself. They also offer things like wills and trusts, advice on reducing debt, and all sorts of insurance, health, life, even tax liability insurance.
Annuities are a central pillar of income security, but they're just one piece of the puzzle, a structure designed to protect and transfer wealth.
And that leads us to our final provocative thought for you. Since securing your essential income for life requires locking up capital-sacrificing liquidity for security, the central question for the modern planner is this: if you're already prioritizing safety for your core expenses,
Which the annuity does.
right, are you then psychologically and financially prepared to aggressively pursue growth with your remaining non-annuitized assets?
That's the real question. The guarantee from the annuity should theoretically unlock your ability to embrace higher risk elsewhere in your portfolio. The challenge for you is determining if you're using the stability of that annuity to just maintain the status quo, or if you're actually using it as a springboard to maximize the returns on your flexible capital.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.